Hey guys, welcome to the Apartment Investing Journey. My name is David Robinson. I'm really excited about our episode today. This is sort of going to be a two-format episode where we're going to dive deep into cost segregation with Erik Oliver, who is a regional manager with Cost Segregation Authority, which is a company that specializes specifically in cost segregation and located in a handful of states across the country and can virtually serve clients in every market, and works directly with investors and their accountants to help them utilize the benefits of cost segregation. And so we're going to dive deep into that today. I'm excited to have Erik on. And so this is going to be recorded in both webinar format, which we will be uploading to YouTube. And there will be a link, excuse me, there'll be a link, goodness gracious. There'll be a link in the show notes to the YouTube episode. And then we'll also have the audio version of this as well. So without further ado, if I can get my voice to cooperate, Erik, welcome to the Apartment Investing Journey. Appreciate you coming on.
I appreciate you having me, David. I'm looking forward to it.
So Erik, if you don't mind, maybe just give us a really brief synopsis of your background and anything you think would be pertinent to add in regard to Cost Segregation Authority, and then let's go ahead and dive right in.
Yeah, so a little bit about myself and Cost Segregation Authority. I've been with the company now for, going on my 5th year. And my background is in accounting. And our firm we're kind of a niche accounting firm where we have CPAs and engineers on staff who complete these cost seg studies. And cost segregation is really all we do. We don't do tax returns. We don't do any audits or anything like that. We're just really focused on cost segregation. And so Cost Segregation Authority has been doing this for just over 12 years now. So been doing it since kind of the early inception of cost segregation.
Yeah, that's great. And if I'm not mistaken, originally you also did, you had other services, CPA services, et cetera, but as of a handful of years ago, you really focused in on specifically cost segregation. Is that correct?
Yeah, so we were associated with a CPA firm, and then about 4.5 years ago, we split off from that CPA firm. Reasons mainly just there was some conflict of interest. CPAs didn't like to turn over their clients to us to do cost segregation services because they were afraid we were going to also start doing their tax return and everything else. And so we really broke off and just really focused on cost segregation about 4.5 years ago.
Great, love it. All right. Well, yeah, let's dive in.
Okay, perfect.
Let's go ahead and kick things off.
All right. So let me advance the slide here. Maybe. Let's see. I might have to close that. Any ideas, David, on how to advance
let's see here. Try your arrow buttons on your.
Oh, there they go. Now they work. Okay, I was gonna say that's what I was trying there, but it looks like we got it going now. So
might have been a little bit delay. All right, go ahead and kick us off.
Yeah. So our objectives today, David, I just kind of want to talk a little bit about this less understood tax strategy and principle. Cost segregation, like I said, has been around for a number of years, but just recently with the new tax changes. The change to the tax law in 2018 has really put this stuff on steroids per se. And so it's even more valuable and important now than it was in the past. So we're just going to kind of touch on what cost segregation is, talk a little bit about the low risk and high value. As I mentioned, we'll talk a little bit about the new tax law, and then illustrate how these strategies can apply to the viewers and the listeners in their own portfolio, and how they can free cash flow, and how can they invest in newer properties and invest in more properties quicker. And then again, just talk about some of these different deductions that are available to us that unfortunately a lot of people don't know about. I'm still, after doing this for 5 years, I'm surprised. We do a lot of presentation to CPA associations and real estate groups, commercial brokerages, and I'm still surprised at how many people are not familiar with cost segregation. And there's a couple of reasons for that. I think we'll dive into that here in a second, but it's important for you guys to know really why and how cost segregation works, because you're obviously in charge of your own portfolios, and a lot of people think, well, my CPA handles all my depreciation, I let them take care of that, but that's not always the case. So it's important for us as investors to know about this stuff.
Great.
All right, so here's my one interactive slide, David, before we jump into too much tax. 40 minutes of tax can be a long conversation. So I have one interactive slide, and then we'll talk tax. But
it sounds good.
The idea here is, do you see the hidden tiger? And we put this slide up, and people will look in the bushes, they'll look up in the sky at the clouds, and the whole idea is the hidden tiger. It's not the big tiger in front of us, but actually, if you look in the stripes of the tiger, it says the hidden tiger.
Oh, wow. That's cool. So if you're just listening to the podcast, you got to go check out the YouTube version, because I didn't see it. That's for sure.
No, it took me a while, and I had to Google the answer, so don't feel bad, David. But, the reason for this slide is a lot of investors, us as investors, we have these deductions sitting at our fingertips. We just don't know they're there. And so that's kind of the point of today, is just let's talk about them. Let's talk about how we utilize them, how to strategically apply those deductions, and we'll get into that now. So a little bit about depreciation. I'm not sure how much you or your viewers know. Most of your investors probably know about depreciation. Standard depreciation typically is, the IRS says that on residential rentals, in your case, it's 27.5 years. Commercial properties depreciated over 39 years. So basically what happens with most of us is we go buy a multifamily building. We then hand the closing statement to our CPA, and they take that $2 million purchase, put it on a depreciation schedule, and depreciate that over 27.5 years. Happens all the time. We see it all the time. And basically you get to take 1/27th of your building value and depreciate that each year. So depreciation is an expense that you get to write off against your income. Now, when you purchase a building, you do have to subtract the land value out. So let's say we buy a building for $2 million. We got to take whatever the land value is. Let's say it's $400,000. So our depreciable basis would be $1.6 million. But you would take that $1.6 million, divide it by 27.5, and that's your write-off each year for the next 27.5 years. It's called straight line depreciation. And a good portion of us investors, that's how we depreciate our properties. It's great. That's why we invest in real estate, because we want those depreciation expenses to lower our taxable income. And what we say is, by doing cost segregation, you're basically accelerating that income, or excuse me, those deductions. So you think about it, how often do we own our properties for 27.5 years or even 39 years? That's not a strategy that's often utilized. And so why not take those deductions now versus having to wait 27.5 years or 39 years. And so that's kind of the whole idea behind cost segregation, is accelerated depreciation.
Let me ask you a question in regard to that. Why is it that the government allows us to utilize sort of this this accelerated depreciation strategy? What's the thought process behind it?
Yeah, so it's kind of interesting, because I think originally they didn't have, it's just the crazy tax law, to be honest with you. Originally, they didn't have the intention of that, but as court cases came out, things like, for example, there's pretty much a court case on every piece of personal property within your building. And so, for an example, carpet has a court case on why carpet should be depreciated over 5 years versus 27.5 years. And somebody at some point took the IRS to court and said, hey, I'm not depreciating my carpet over 27.5 years. It doesn't last 27.5 years. And so we've got these court cases. We've got established provisions that basically say that all these different components in our building can be depreciated over a certain amount of period, or a certain amount of time.
They have a certain life.
They have a certain life, exactly. So, and I think the court cases probably came about when somebody replaced carpet. So when you have a, you have a multifamily building, a multifamily unit, and you replace carpet, let's say you replace $60,000 worth of carpet. The IRS states, instead of that $60,000 being a 27.5 year asset, which we know is not the case, let's depreciate it over 5 years. So then people started thinking, saying, well, hey, if the IRS lets us depreciate carpet over 5 years when we replace it, why can't we depreciate it over 5 years when we buy a new building that's got carpet in it? And so I think that's kind of where cost segregation and this component depreciation kind of was established. And so there's an IRS depreciation book that's thousands of pages that basically gives you the life of every single component that you could ever think of.
Gotcha.
And so what we do is we come in and we do an engineering-based study, and we reclassify your assets from real property to personal property. And so you think about when you buy an apartment building, not only are you buying the land, the walls, the bricks, the roof, the HVAC, but you're also buying all the appliances, all the countertops, cabinets, ceiling fans, garbage disposals. All those things are short asset life components. And so what we do is we come in and put a value on those things and provide you and your CPA a new depreciation schedule that says, hey, of my $1.6 million building, 300,000 of that is things like carpet and countertops. 400,000 of that is land improvements, things like asphalt, curbs, gutters, irrigation systems. And so we break out all those different components of your apartment building, provide you and your CPA a new depreciation schedule, and you get to accelerate the depreciation and depreciate that $300,000 worth of 5-year assets over 5 years versus 27 and a half. So you're basically front loading the depreciation in the early years. And we'll get into the number of reasons why you do that. Things like time value of money. There's a difference in the tax rates, and we'll get into those here in a second, but that's kind of the idea of cost segregation.
So real quick, just to clarify, the real property can only be depreciated on the straight line depreciation schedule of 27 and a half years for residential. Is that correct?
Yep. That's basically okay. Your actual structure, your walls, your building components, your steel, your sheetrock, all that stuff is straight line depreciated. So
the accelerated depreciation schedule only applies to personal property, and that's the role of the cost segregation study, is to separate out the components of the structure and anything else inside the structure that can be considered personal property.
Correct. Yep.
Great.
Yep. So we'll go ahead and jump this. I like this slide here. We get this quite often. Is this some kind of tax loophole? I've never heard of this. I actually just worked with a CPA in Hawaii who's been in business for 20 years. She works with a lot of real estate investors, and one of her investors introduced me to her, and this is the first time she'd heard about it. And she's like, am I going to go to jail for doing this? I'm like, no, Aaron, you're not going to go to jail. This is legitimate. Here's the IRS audit guide. It's not some kind of tax loophole. A lot of big commercial developers have been using it for, like I said, 10 to 12 years. But this is from the IRS audit guide. It says it's desirable for taxpayers to maximize personal property costs in order to accelerate the depreciation deductions and hence reduce their tax liability. So just wanted to throw that slide in there in case this is
it's right. It's right in the audit guide, right there from the IRS.
Guide, so, all right. So a quick history on cost segregation. This used to be 5 or 6 slides, but this is, again, no one wants to listen. I mean, talking tax for 45 minutes is hard enough, but let alone to talk about the history of tax makes it even harder. So I've kind of narrowed it down to one slide, but basically there was an important court case back in the late 90s with Hospital Corporation of America. They are a hospital outfit out of, I believe they're in Tennessee is where they're headquartered, Mid-Atlantic area. And they've got a number of hospital systems, 200 and some odd hospitals. But basically they were a little strapped for cash. And they had some creative accountants who said, again, hey, why are we treating carpet as a 5-year asset over here, IRS, but we're treating carpet when I buy a building as a 27.5-year asset or a 39-year asset? There's a problem there. We're not on the same page there. So they basically went through and did the first cost segregation study and depreciated all the different components of their building on shorter asset lives, and it ended in a $700 million depreciation expense. And as you can imagine, the IRS was like, whoa, wait a minute. You guys, where did you get this $700 million worth of depreciation? And they said, look, you've stated here that carpet's a 5-year asset. We're depreciating our carpet over 5 years. And so long story short, they ended up going through all the way to the highest tax courts, and an opinion was issued in July of 97. And basically they said, the IRS said, hey, 85 to 90% of what you guys are doing is absolutely correct according to the way that the regulations are written. And so that's kind of where modern cost segregation was born. Originally, it was just for your big institutions, your big, huge apartment complexes, casinos, hotels. The reason for that was the cost of the study basically was, $20,000 to get one of these studies done. And so it really only made sense at that fee structure that if you were going to get a decent return on your investment, that you had a substantial property. Nowadays, we do anything from $60,000 tract homes in the middle of Tennessee upwards to ski resorts. So it applies to anybody that owns revenue generating property. Can't be done on your personal residence, but any revenue generating property, you should at least look into cost segregation. Not saying it's going to make sense, but definitely look into it. And so that's kind of where cost segregation was started and kind of the early founding of cost segregation. So with that being said, there's really three rules we look at, David, or sections of the IRS code that we look at when we identify what is personal property. And so the first rule is, can the property be removed without damaging the building or structure? Then it's personal property. So again, these are things like carpets, countertops, window coverings, ceiling fans. There's a whole laundry list of things that we can identify that you can basically, if I rip up the carpet in this building, the walls aren't going to collapse. And so it's removable, and therefore it's probably personal property. The second would be if the relationship between the asset and the equipment or the machinery is so close that they're going to be retired at the same time. And this is one we see missed quite often when CPAs try to perform these cost seg studies on their own. But an example of that would be if you've got a TV mounted in one of your apartment buildings and you've got a plug behind that TV as well as conduit coming from the cable company, those electrical components were put into that wall specifically for that 5-year asset. Therefore, they're also considered 5-year property.
Interesting.
You think about an apartment complex, how much of the electricity going into apartment is for things that are considered personal property, such as washers, dryers, dishwashers, garbage disposal, ceiling fans. So sometimes we can see upwards to 50% of the electrical system we can segregate out into short asset lives because it's specific for, again, things like washers and dryers and that type of thing. So oftentimes that's one that we see missed on cost seg studies that are done sometimes by CPAs. Because they know they can take the washer and dryer, but they don't always realize that they can take the plumbing and the electricity that were put into that unit for the washer and dryer.
Interesting.
So we put a value to those components as well. And then the last one is the relationship between the asset and the nature of the business are unique. Give you an example on this one. We did a meadery. I don't know if your viewers know what a meadery is, but a meadery is they make an alcoholic beverage from honey. It's fermented honey. And this meadery is in Arizona. And as you can imagine, with the heat in Arizona, it could be hard to work with this honey if it's 120 degrees outside. So they've got this big warehouse with this specialty cooling equipment. Well, that cooling equipment, typically we don't get to segregate out HVAC systems to keep you and I cool. But if you have a cooling equipment because you have to keep honey cool, that's considered personal property. Same thing with clean rooms, or if you've got a room full of servers and you've got an air conditioner in there just to keep those servers cool, you can segregate that out. And so that's the third rule on when you would segregate out different components. I just wanted to give you guys a kind of an understanding of how we identify that person.
Yeah, those are great examples of those 3 different buckets.
Yeah, so, and here's for those of you who are watching this on video here, you can see the different categories. So things that are considered real property, this is your building. This is stuff we can't segregate out. Things like steel structure, roof, walls and doors, windows, HVAC systems, plumbing and electrical systems. And again, that's portions of the plumbing and electrical. So the plumbing and electrical, like electrical systems, the lights, we don't get to segregate out lights. Buildings have to have lights to be considered buildings. Buildings also have to have bathrooms to be considered buildings. So there's nothing that we can segregate out in a bathroom, even if the bathroom has carpet or light fixtures or anything like that. We don't get to segregate that stuff out. But those are your real property. Then you've got your land improvement, which is your 15-year category. That's things like parking lots, asphalt, curbs, gutters, storm drains, irrigation systems, retaining walls, trees, shrubs, and landscaping. Sometimes people will look at us funny when we're out walking the building, counting the trees and shrubs. But those are 15-year assets according to the IRS. So we get to depreciate those over 15 years versus 27 and a half years. And then the last category is your 5-year stuff, which I've touched on: carpets, countertops, cabinetry, auxiliary lighting, specialty plumbing, window treatments, wall coverings, removable flooring. Basically the inside of your building that can be easily removed. Those are your 5-year assets.
So quick question, generally speaking, and obviously the purpose of the cost segregation study is to get very clear on each one of these components and what can be separated as real property versus land and personal property. But generally speaking, what percentage of the value of a building ends up being able to qualify for the accelerated depreciation? Is there sort of a rule of thumb or anything like that that an investor could sort of just have an idea of the range that they might fall in?
No, that's a great question. Yeah, so I always like to use 30%. So basically, when you buy a building for $2 million, you subtract out the land. The remaining is your depreciable basis. And of that depreciable basis, we're going to segregate out somewhere around 30%.
Gotcha.
Now, some properties are a little lower. You think about an empty warehouse is going to be a little bit lower than an apartment complex, for example. But anywhere from 25 to 35 is typically where we see our studies come in. And so just kind of as a rule of thumb, I like to use 30% as an investor just to kind of run some simple numbers. Yeah.
Yeah, that's helpful.
All right, so let's jump into a case study real quick. So this is a typical fourplex. The acquisition cost minus the land was $400,000. The purchase date was July of 17, and that's kind of important because there was a tax law change at the end of 17. So this was before the tax law changed. And we're going to go ahead and do the tax return on 18's tax for the 18 tax year. So here you see on the blue section on the left, for those of you who are viewing it, is your depreciation without cost segregation. So this was a $400,000 asset. Take that $400,000, divide it by 27 and a half, and you're going to get basically a $15,000 write-off every year against your income. That's a depreciation expense that comes off, and you get that for the next 27 and a half years. And that's typically what we see on depreciation schedules. What we're saying is, let's take that $400,000, this green section here, and let's break that up into 5, 7, and 15-year assets. So in this example, of the $400,000 asset, we found $68,000 worth of 5-year assets, $4,000 worth of 7-year assets, and $60,000 worth of 15-year assets. And you can see that the 5-year assets get depreciated over 5 years. Your 7-year assets get depreciated over 7, and your 15 the same. And what that does, when you push all that through, it's going to create an increase in depreciation in the first year of $38,000 or $38,411. You take that $38,411 times your tax bracket. In this example, we use the 38% combined rate. That's a tax savings of about $14,000 on this study. Just to put that in perspective,
in year one.
Like this, in year one, correct. And to put that in perspective, a study like this is probably going to cost you around $2,000 to complete on a fourplex. So, you pay us $2,000, you save 14.5 on your taxes, basically.
Yeah, that's significant.
So, significant, yeah. We like to see somewhere between a 10 and 12 times return on your investment at a minimum. And those numbers are even higher now with the new tax law, which we'll jump into here in a second. But if we're going to charge you $2,000, we want to see you save, somewhere between 15 and 20 on your taxes at a minimum.
So if you guys are just listening to this on the podcast, make sure you go check out the YouTube version. And throughout this entire presentation, the graphs and the charts that Erik's covering will be very helpful to helping you understand and see it from a visual perspective as well. So go check out the YouTube version of this training.
Yeah, absolutely. And you'll see there, David, at the bottom, we're not increasing any depreciation. We're still taking $400,000 over the life of the asset, whether you do cost seg or not. But we're just taking a big chunk of it sooner. And there's, like I said, a number of reasons why we would do that, because typically we don't hold the property for 27 and years.
Right.
So along with not only the increase in initial depreciation in that first year, there's a number of what we call bonus benefits that go along with cost segregation. One is catch-up depreciation, which we'll touch on. Actually, I'll touch on all of these, but one is called catch-up depreciation. There's a reduction in recapture, which we'll go into. There's partial asset dispositions and bonus depreciation. So let's just go ahead and jump into the catch-up depreciation. But basically, we oftentimes will get asked, well, hey, Eric, I've owned my building since 2010. Is it still eligible for cost segregation? And the answer is absolutely. Sometimes those have a greater ROI than on a new property. And the reason for that is the IRS allows you to do what they call a look-back study and catch up the missed depreciation that you should have taken from 2010, 11, 12, 13, all the way to today. You get to take that missed depreciation and drop it on your current tax return. Doesn't require an amended return. There's a form that we provide you and your CPA, a Form 3115, that you submit with your tax return. And that form basically says, hey, IRS, I've been doing straight line depreciation on my asset for the last 6 years. I'm now going to accelerate that depreciation, and here's the difference. And you get to take that difference on your current tax return. And so for those of you guys who own properties, who paid taxes in 18, you may be able to utilize some of those existing properties to offset your tax liability. And so we'll just jump into that same example, but let's say that same example, it was a $400,000 fourplex, but instead of buying it in the current year, now I bought it back in 2014. So now I've owned it for 5 years. Well, in this example, 4 years, because this is a 2018 tax return. But now I've owned it for 4 years. So, but if you look at the graph here, you'll see in that green section, the numbers are all the exact same. It's just that the years 1, 2, 3, and 4, we get to push all that into the current tax year. It's now created a $68,000 increase in depreciation. Same price for the study, but you get to take $68,000 now in the first year. And you take that 68,000 times it by your tax bracket, that could be anywhere from a $20,000 to $25,000 tax savings. In this example, we're using a 38% tax bracket. So that's a almost $26,000 tax savings on a $400,000 fourplex.
Interesting.
So imagine if it was a $4 million fourplex, you add zeros to the ends of all these numbers, and all of a sudden you just save $250,000 in taxes.
Right.
Significant numbers there. But any questions on that, David? You kind of see how
this makes sense. With the graph and the breakdown makes a lot of sense.
So great opportunity there. All right, so now we're going to touch a little bit about the sell of an asset. So oftentimes we get asked, so Eric, why am I going to do cost segregation and take all this depreciation up front? Because when I sell the asset, I'm going to have to pay it back in the form of recapture.
Yeah, I would say this is the biggest concern that people that I am in communication with, and the conversation of cost segregation comes up. This is the biggest concern they have is, man, yeah, it's all great to take it up front now, but what happens on the back end? And I don't want to be hit with a big old tax bill. So this will be great.
So let's kind of walk through that, and I'll show you how that works. But basically, when you sell an asset, you pay 2 taxes. You pay a capital gains tax and you pay a recapture tax. And both of those are paid upon sale, unless, of course, you do a 1031 exchange or something along those lines. But typically, you pay those taxes upon sale. And the recapture tax is calculated based on the amount of depreciation you've taken. So again, like you were saying, people are going to say, why am I going to take all this depreciation? If I sell it in 5 years, I got to pay it all back. And there's 3 reasons for that. One is the time value of money. So take those dollars today, go invest it in a new fourplex, and $1 today is worth more than $1 5 years from now. So let's just say we did have to pay it back dollar for dollar at the same rate. You've had your money for 5 years to utilize, to go invest, buy new property, etc. So that's the first thing. The second thing is that you don't have to pay it back at the same rate. So on those previous examples, you'll remember we took the deduction at a 38% tax bracket. The recapture rate is 25%. So that difference, that 13% difference, is a permanent tax savings that goes right into your pocket. So there's a difference in tax rates. That's the second thing. And the third thing is, which is the most important and probably the least understood, is that you get to actually reduce or eliminate the recapture tax on your personal property by doing a cost seg study. So again, I'm taking my deductions today at a higher rate and picking them back up at a lower rate in the future on a lesser amount. I know that's a mouthful, but we'll walk through that here in a second. Let's walk through it now, actually. So let's just a case study here. We've got an apartment building we purchased in 2012 for $2.5 million, and we sold it 5 years later for $3.3 million. So if you don't do a cost seg study, you're going to have to pay on that $2.5 million purchase over the 5 years. Let's just say, for example purposes, you took $500,000 of depreciation. You're going to have to pay back that $500,000 at a 25% tax or a 25% recapture rate. And I've circled that there on the screen for those of you who are watching.
Yeah, that's helpful.
That's $125,000 of taxes I've got to pay back upon sale. I also have to pay $160,000 of capital gains tax at 20%. So my total tax bill is $285,000. So again, typical real estate transaction, I buy it for 2.5, hold it for 5 years, sell it for 3.3. Of that $800,000 of gain, I have to pay 285 of that to the federal government in the form of taxes. So typical real estate transaction happens all the time. What we're saying is by doing a cost seg study, this next slide here, whoops, let me clear off those marks there. Let's see. Just give me 1 second, I'll clear these off here. And we can advance to the next slide. Okay. But what we're saying is by doing cost segregation, oh, David, I think it's locked it up again. Is there something on your end that you can hit there?
Let's see. Try now. Try using your.
For whatever reason, every time there we go. Perfect. All right. So, but what we're saying by using cost segregation, now this slide, for those of you who are viewing it, there's a lot of numbers here. I don't expect you to know what all these numbers mean. It's taken me 3 years to figure this out. So you're not going to figure it out in the next 30 seconds. But basically what I want you to think about is on that same example, in this scenario here, we've segregated out those different components. So of the $2.5 million original purchase, we're saying that there's $425,000 worth of 5-year assets, and that's denoted here. We're saying there's $25,000 worth of 7-year assets and $375,000 worth of 15-year assets. So you bought it in 2012 for $2.5 million. You had us do a cost seg study. We broke it out of these different categories. Now, we've accelerated the depreciation in those 5 years. But let me ask you, David, what is the value of my $425,000 of 5-year assets? What's the value of that after 5 years?
Well,
it's
zero.
Right? The IRS said that all those $425,000 worth of assets were depreciated over 5 years. We've owned it for 5 years. So the book value is zero. You can see there's no number there.
Mm-hmm.
The book value of my 7-year assets is $3,000. The book value of my 15-year assets is $210,000. So by doing cost segregation, we've now eliminated, and we've been very conservative in this example. We're saying that, okay, the book value is zero, but we're going to give it a 10% valuation upon sale. Our 5-year property, we're going to give it a 10% valuation. So we're going to pay a recapture tax on $42,500.
And is that just an effort to be conservative so that you're not pushing the limits?
It is. So we work with a number of CPAs across the country who will pay 39% of zero. Because if they say, we've owned it for 5 years, it's got a book value of zero, I'm going to pay 39% of zero. Now, I should note here that on your personal property, the recapture rate is recaptured at your ordinary income rate. So that's why you see 39% there versus the 25% over here.
Gotcha.
So just keep that in mind. But again, I'm paying 39% of $42,000. So that's
Yeah.
a much smaller number. So basically at the end of the day, when all these numbers push through, your total tax bill is now 203 versus on the other slide, it was 285. So that's a tax savings of $81,000 by completing the cost seg study. So think about it. You've had your money to utilize over the last 5 years. And when you sell it, you're going to pay $81,000 less of recapture.
Mm-hmm.
Now,
Makes sense.
Yeah, it does. And like I said, there's a lot of numbers here. I know that, and especially for those of you who are just listening, but the whole idea here, David, is you're not going to sell your 5-year carpet for more than you bought it for 5 years ago.
Right.
And when we don't do cost segregation, that's what ends up happening. So basically, if you don't do cost segregation and you have one big asset on the books, you're saying that this asset went up by 800,000. So you're saying everything from the landscape to the concrete, to the building, to the carpet, to the ceiling fans, everything went up by that percentage. And we just know that's not the case. All your 5-year stuff inside went down in value.
Mm-hmm.
Your carpet's 5 years old. Your cabinets are 5 years old. They're not worth more than what you bought them for 5 years earlier. And so by doing cost segregation, it allows you to manage the allocation of the sales price. And that's real important because we walk through this kind of with CPAs all the time. But when you have a sales price, when you sell your property, you get to allocate the sales price to these different buckets. And by doing a cost seg study, you can allocate it accordingly to where the value is. The value on this property didn't go up in the carpet. It went up in the land and the structure.
Mm-hmm. That's
where the value went up. And so we get to allocate it to the land and the structure. And by doing that, we get to manage our recapture and at the end save $81,000 of recapture. So kind of important, kind of an important strategy. I don't know if I'd call it a strategy, but just an important way to look at cost segregation. It's oftentimes not very well understood is, well, what about this recapture? I keep hearing people talk about recapture tax. And yes, you do have to pay a portion of that back, but you're paying it back at a lower rate on the lesser amount. And that's really, at the end of the day, what all of us want to do. So,
and you've held it for however long.
Yeah, and you've held the property and had those additional tax savings for 5 years to go reinvest and buy new properties, et cetera. So, any questions on that, Dave? Like I said, I know that's a lot of information to kind of go over on a.
Yeah, no, I think you did a great job of just explaining the overview, how it works in that first $425,000 example, and bringing it down to the bottom line, which is really in this scenario, even though you do have to pay the recapture, you're paying roughly $80,000 less than you would have otherwise.
Correct. Yep. Very good. All right, so I'm gonna see if this will let me advance slides here. You might have to, since I used the pen there, I don't know why it's.
Yeah, it just takes a second to get off
maybe.
of that. Yeah. All right, try it one more time.
Let's see here. Let me try this. There we go. All right. All right, so let's talk quickly just about partial asset dispositions. So when you do a cost segregation study, one of the additional benefits is the ability to take partial asset dispositions. So again, let's use the example of carpet. But when you buy a building, you buy the carpet that's in the building, obviously. But let's say that carpet, after 2 years, you replace all the carpet. Well, if you do a cost segregation study, you know the value of that carpet, and you also know what the remaining value is after 2 years. So let's just say, for example, to make the numbers easy, you buy a building, we do a cost seg study, we identify $100,000 worth of carpet. And after 2 years, you decide you want to rip out that carpet because it's dirty and you've got new tenants coming in. That $100,000 worth of carpet, you've had it for 2 years, so you've depreciated it down to, let's just say, roughly $60,000, which would be 2/5 of the $100,000. So you've depreciated it, those 2/5. You now have 3/5 remaining in value, which is $60,000. You get to write off that $60,000 as an expense, as a partial asset disposition. So you're retiring that carpet, you're pulling it out of your building. It still has value, $60,000 according to the books. You get to write off that $60,000 as a partial asset disposition. You then get to take your new $100,000 worth of carpet, put it in your building, and start depreciating that $100,000 worth of carpet over 5 years. So You only get to do that if you do a cost seg study, or if you have a savvy CPA who can identify what the value of that carpet is when you remove it. Because remember, if you don't do cost segregation, your depreciation schedule is going to say building $1 million, 27 and a half years.
Mm-hmm.
So when you pull out that carpet, it's real tough for your CPA to say, well, what was the value of that carpet when I pulled it out? I don't know what it was. I don't know what it was originally. How do I know what it is after 2 years? So by doing the cost seg study and having all these different components line item on your depreciation schedule, when you retire any of these components, whether it's a roof or carpet or cabinets, you get to write off the remaining basis. And that's considered what they call partial asset disposition. And so that's a great, just to give you a quick example of a great story here, a case study. This gentleman we worked with, he bought 2 homes next to each other that he was turning into residential assisted living centers. And those 2 homes, when he bought them, they had tenants in them, renting tenants, one for 3 months and one for 4 months. So he bought those 2 units for roughly $500,000 a piece. And we went in and did the cost seg study on the 2 existing buildings. After the tenants' leases were up, he had the tenants removed. He didn't renew the lease because he knew he wanted to put them into residential assisted living centers. He then gutted them, took the partial asset disposition on what we had identified, and put another $500,000 into each of those buildings, and he was able to depreciate the $500,000 of additional remodel on top of that. So it was kind of like a double whammy for him, but
Interesting.
he had a great depreciation expense to begin with. He had a huge partial asset disposition. And then on the back end, once the remodel was complete, he got to do the cost seg on the remodel as well.
Wow.
So if you think about it, what happens if you don't do cost seg and you remove your carpet and you just have it stuck in that one building cost, and then you add your new carpet and start depreciating that? What happens is you're now depreciating 2 sets of carpets, even though the one set of carpet has been removed. Does that make sense?
Yeah, absolutely.
By not pulling that out of that original purchase or that original building cost, you're double depreciating your carpet, which on the back end, because you have to pay recapture, you're increasing your recapture tax.
Yeah.
So it's real important to pull those assets out as you retire those assets. And so that's one of the benefits of cost segregation, is it allows you to pull those out. All right, so we're just about finished up here, but let's quickly touch on, this is probably one of the most important things we'll talk about today, David, but this is the new tax law and bonus depreciation. And so under the old tax law, there was something called bonus depreciation. And here on the screen is what the rules for bonus depreciation. The first one was, in order to take bonus depreciation, you had to have original use property. So in the real estate industry, that meant you had to build something new. You had to build a new fourplex. You had to build a new apartment. You couldn't buy existing apartments or existing fourplexes. The second thing is that the recovery period had to be 20 years or less. So again, this is in the infinite wisdom of the IRS. I don't think they realized how this applied to real estate, but we know real estate is 27.5-year assets or 39-year assets, correct? But
right.
The recovery period, in order to be eligible for bonus, is 20 years or less. So the only way to get this bonus depreciation in the old world was to do a cost seg study, because we come in, we look at your 27 or 39-year asset, and we identify 5, 7, and 15-year assets. Well, those 5, 7, and 15-year assets are all under the 20-year or less category. So you were eligible for these bonus amounts. Now, bonus depreciation doesn't mean you get additional depreciation. It just means you get to take additional depreciation up front. So here on this graph here, you'll see in 2001 to 2003, if you built a new building, had a cost seg study done, you would get to take 30% additional depreciation in the first year. So let me just simplify that. If we find that there's $100,000 worth of 5-year assets, instead of depreciating those 5-year assets over 5 years evenly, you get to take $30,000 up front. The remaining $70,000 or 70% is depreciated over the next 4 years. So you can see how these numbers fluctuated over the years. Like in 2004, it was 50% bonus. There was kind of a golden period there in 2010 where you got to take 100% bonus, which was great. So if I find $100,000 worth of 5-year assets, you get to take $100,000 write-off in the first year.
And this is just the change with tax law.
Yep, this was just, yep, they would every year, they use this bonus depreciation to kind of stimulate the economy. So they would look at how the economy was doing, how the markets were doing, and they'd say, okay, we really want to stimulate building, and we want people to go out and buy new stuff, build new stuff. So let's give them a bonus. Let's say they get to depreciate it quicker if they buy it in this period. And here's how quickly they get to depreciate it. So that's all old tax law. This was the old tax law here. The new tax law changed a few things. One, it got rid of the original use property. So you no longer have to build a new building. You can just buy a building and you're eligible for bonus, which is great for investors. You no longer have to go out and build a new building. Just go buy an existing building and you're eligible for bonus. That's great. The second thing is it's no longer 30, 40, 50%. It's actually 100%. So, and this is huge. This is, if you think about it in context of what we just talked about on cost seg, anything that we identify as 5, 7, or 15-year property, when we do the cost seg study, you get to take 100% of that and depreciate it in the first year. So if you remember, David, I think I told you it was, what, 30% roughly we figure?
Right.
So you could buy $1 million building, you can now have a $300,000 write-off in the first year.
In year one.
So you're going to reduce your taxable income by $300,000. $300,000 times a 30% tax bracket, that's $90,000 of tax savings.
Yeah.
That's significant.
Absolutely.
So this 100% bonus, under the way the current law is written, this 100% bonus is good through the end of 2022. So any properties that were purchased, this is kind of a funny date here, but 9/27 of 17. I don't know why it's 9/27. I think somebody in Congress probably bought a property on the 28th. And so they're like, okay, let's backdate this, because everything else in the tax law took effect basically on January 1st of 2018. But this portion of the tax law, this bonus depreciation, this 100%, is anything purchased after September 27th of 2017 through the end of 2022 is eligible for 100% bonus. Now, after 2022, each year that'll go down by 20%, assuming the law doesn't change.
Which, depending upon the economic climate at that time, it could very well change.
The economic climate, depending on what Trump tweets in the next half hour,
right.
Depending on the impeachment. I mean, we got all kinds of things going on. So
sure.
My guess is if the Democrats were to win two out of the 3 in Washington, they would probably get rid of this 100% bonus, but
gotcha.
At the current moment, that's where it's at. Oh, there's Trump coming in on the slide saying this is huge. I don't know if you guys know this, but Trump owns real estate. And so when he wrote the tax law, he wrote it very favorable to real estate investors. And so we can thank him for that. So anyways, just wanted to throw that in there. But yeah, so 100% bonus depreciation, good through 2022. And this can create massive, massive deductions. So let's take a look at the last example we've got here. But let's take a look at that same fourplex. That's a $400,000 fourplex. Now we've purchased it after that September 27th date, so under the new tax law. The depreciation or the segregation numbers are the same. You'll see there that we still segregated $68,000 worth of 5-year assets.
Mm-hmm.
But now we get to take that $68,000 in the first year. We don't have to depreciate it over 5 years. So you get to take that $68,000 and you get to write that off in the first year. So you can see no longer, in the other examples, we had $68,000 down here, but we also depreciated that over 5 years.
Over 5 years, yeah.
Same thing with our 7-year assets. You'll see you don't have to depreciate those over 7 years. And our 15-year assets, we no longer have to depreciate those over 15 years. We get to write all that off in the first year, which in this example, same example, $400,000 fourplex, it now creates $129,000 of increased depreciation, which at that same 38% tax rate is going to be about a $49,000 tax savings.
Wow.
So let that sink in. I mean, those are big numbers there.
Yeah.
The good news is some investors, depending on, maybe they have a W-2 job and they're doing this investing on the side, what have you, they may not be able to utilize a full $129,000 of depreciation expense. So there's different ways that you can tailor how much depreciation you take. So a lot of investors that we work with, for example, will say, okay, Eric, this $60,000 of 15-year assets right here, I want to take that 15 years and I want to depreciate that 100% bonus. I want to write that all off in the first year. But my 5-year assets, let's just go ahead and depreciate those over the normal 5-year period. And what that does is it gives them less of a bump in year 1 and a little bit, it spreads it out over the first 5 years, if that makes sense.
Yeah.
And the reason for that, David, let me just touch on this real quick. I just want to add, because I should have mentioned this earlier. The deductions we create by doing cost segregation are passive deductions.
That's what I was just going to ask is, does this apply to your W-2 income or just passive K-1 income?
So this just applies to your passive income. So in this example, like I said, we created a $129,000 depreciation expense. But if this was the only passive income generating property I had, and let's say this $400,000 fourplex only generates $20,000 of income every year, there's no point in creating a $129,000 depreciation expense because you can only write off $20,000 of income.
Mm-hmm.
Even though I'm a doctor and I make $500,000 a year, if this is the only property that I own, it may not make sense to do cost segregation and get a $129,000 depreciation expense, because the good news is, David, you get to carry that forward. So let's say I do just have $20,000 of passive income. I'm going to wipe out my $20,000 of passive income and then carry forward the $109,000 for next year. But again, why are we going to pay somebody to accelerate my depreciation if it's going to take me 10 years to utilize it?
Mm-hmm. So this is probably a good place to ask this question.
So in that case, you wouldn't do that. So
probably a good place to ask this question. Maybe you're going to cover it here, but what about the real estate professional designation, and how does that apply here?
Yes. So if you can qualify, if you or your spouse, if you file jointly, can qualify as a real estate professional, it takes this passive deduction and turns it into active. And it then can hit all of your active income. So we see this quite often with, let's say, a couple where one of the two in the couple stays home and the other one is a high W-2 earner. The person who stays home, if they can qualify as a real estate professional and they own real estate, they can offset their partner's W-2 income. So we see this a lot with doctors or dentists, or, where one party's, making $500,000 a year, the other party stays home. If that other party can qualify as a real estate professional, they can then create this type of deduction in their real estate, and it can be used to offset the W-2 income.
Actual W-2 income. And do you know the just general requirements for the real estate professional qualification?
Yeah, so kind of the big ones are 750 hours of real estate activity a year, which equates to, I think, about 16 hours a week. The other one, which isn't a lot, but the other one is, this is where people get caught up, is you have to spend 51% of your working time doing real estate.
Gotcha.
So the IRS they're pretty big sticklers on, if you have a full-time W-2 job, they're going to question you pretty hard on whether or not you're working an additional 41 hours doing real estate.
Right.
They're going to say, there's no way you're doing 40 hours at your regular job and 41 hours doing real estate. And so unless you have it really documented, I mean, you could do it. I've seen people do it, but you just have to prove that you're working 80 hours a week, 52 weeks a year, which is tough to do.
Yeah.
So
cool. That's great.
Yeah. So that's kind of the big ones. But if you can get that real estate designation, it can open up the door for these huge depreciation expenses. The other thing that I'll add is, for those of your investors who are investing in properties where they run a business out of, there's a grouping allocation that can help with that as well. So if you think about, we do this again for doctors, or we did it recently for a gentleman who owns a roofing company. We did a cost seg study on his roofing warehouse. Because he runs his roofing company out of that warehouse, we can group his real estate entity. He owns that real estate, that warehouse, in a LLC, and he also, or an entity. He also owns his operating company, his roofing company, in a separate entity. We can group those two entities together because he operates out of that building. And that allowed him to take the depreciation we created on the real estate side to offset his roofing company income. If that makes sense.
Yeah, absolutely.
So there's a grouping allocation as well. So that's something that you can look into if you've got
this is great
passive loss issues. But and I think, David, that's about, let me get rid of these drawings here. I think that's about it on the slides. Let's see. close this out and go on here to the next slide. I'm pretty sure that's about it. While I'm waiting for these slides, one thing I think the next slide basically is just going to say that before you ever engage somebody to do a cost seg study, please ask for a benefit analysis. Most cost seg providers will provide you what they call a feasibility study or an initial benefit analysis that will give you an idea of what your expected tax savings would be by doing a cost seg study. And then, you know, we never want to engage somebody if they're not going to have a significant return on their investment with us. And so we run that benefit analysis free of charge. We gather just a little bit of information from you. If I can go to this next slide here, there we go. Actually, I think it's the next slide, but we gather a little bit of information from you. We run some preliminary numbers to say, here's at what a minimum we're going to be able to do on this property. And then you look at your income levels and decide, well, is this a good time to do it or not? Couple things that actually going on to this slide here. When would you do a study? If you currently own any income generating property, doesn't matter if you bought it 10 years ago, you can still have the stuff, we can still look into it. If you purchase an existing building, if you renovate, remodel, or make leasehold improvements before you sell, and property with any kind of step up. So if you inherit a property, it's a great time to do cost segregation, or at least look into it. And the last slide here is, here we go, is how to proceed. And that's just basically by giving us just the year you bought the property, the purchase price, the type of asset, you know, whether it's a retail building, office building, multifamily, and the address. We can run a benefit analysis and say, hey, at a minimum, we're going to create this amount of tax savings. And it's just a matter of cost segregation. The only time you wouldn't do cost segregation is if, one, you have that passive loss issue that you talked about, David, where you can't utilize the deductions, or if you're not paying taxes. Any other time, it's just a timing thing to see, okay, well, this year I've had a lot of income. I didn't have a lot of renovations, so I didn't have a lot of expenses on my property, so they cash flowed real heavy. I'm showing $80,000 of rental income. Do a cost seg study on one of your properties and offset that $80,000 and don't pay tax on it. Free up that cash flow. So it's just a matter of time. And cost segregation is very flexible. You can kind of utilize it and just keep it in your back pocket and utilize it as you need it. So my recommendation for you guys would be have the benefit analysis run on all your properties and keep that, you know, have the information available so then you can determine as you're tax planning every year with your CPA, hey, what's my tax liability? Oh, I made $300,000 of income this year. Well, let's offset some of that income with some of these cost seg studies. Yeah.
And do you, is there any charge for the benefit analysis?
No. So like I said, we do it for free. Most companies, most cost seg companies, I believe, do it for free. Because the last thing you want to do is, like I said, have somebody pay you a bunch of money to do these studies and then find out they didn't save any money on it.
Sure.
So,
sure.
We always want to make sure and make sure they're going to have a significant savings before we ever engage them to pay us anything. So,
yeah, this has been great. This has been great. Anything else that we need to cover?
I think that's it. I know it's cost segregation. If you think about it, it's fairly simple, the idea. I think where people get caught up, and even where some CPAs get caught up, is just how to apply it to their current situation. And so if any of you guys have any questions, this next slide here, again, my name's Erik Oliver. My direct cell phone number is 602-568-0032. Feel free to give me a call. I'm happy to walk through your situation if you have a particular situation and kind of talk to you about how cost segregation may or may not apply to you. But just use this as a resource. Like I said, we're experts in this industry. Please don't call me and ask me about how to file a child tax credit, or I don't know any of that stuff. But when it comes to depreciation and real estate depreciation, please use this as a resource. We love to jump on a call. We see all kinds of different things from different CPAs around the country, how they're handling different things, how different investors are handling different things. And so we're kind of on the front edge of seeing how to best utilize these deductions. So again, just use this as a resource, and feel free to call me if you have any questions.
Yeah. Well, Erik, I appreciate your time. I think the case studies were very, very helpful, as well as, you know, the spreadsheets and the breakdown. So again, I know I've mentioned this, but if you haven't already, go check out the YouTube version. We'll have this up at our YouTube channel, Apartment Investing Journey. And then one question I did have for you is, if someone wanted to engage with you, generally speaking, do the investors that you work with generally engage with you through their CPA or directly with you and then connect you with their CPA? What's the best approach?
That's a great question. Typically, so we work with both building owners and CPAs. Most CPA firms, only the real large, maybe the top 10 in the country, have an in-house cost segregation group. So most your regional or local CPAs will partner with a company like ours to do the cost seg work. But definitely, as a building owners, I mean, I would definitely mention it to your CPA. You might get some pushback. Oftentimes CPAs will say, you know, this only applies to $1 million buildings, or there is some misinformation out there. But feel free to contact us directly. We always want to get the CPA involved because they have information that we don't have, such as income levels, other deductions you may have that are carrying forward. So before we ever engage somebody in a study, we always get the CPA on board. But I would say for most real estate investors, they're usually contacting us first. We're running the benefit analysis, and then from that point, we're getting the CPA on the phone to say, hey, CPA, here's what we can do. Does this apply to this situation? Does it apply to this tax year? What other things do we need to know about that might offset what we think we're going to be able to save in taxes? And we really just want to partner with the CPAs. I look at CPAs as kind of your general practitioners. They need to know a little bit about a whole wide array of subjects. They just don't have the bandwidth to stay on top of the new tax law and cost segregation and how it applies. And so we just want to be that resource for them and for the building owner. So we always partner with the CPA and say, hey, here's what we can do. Does it apply to your client? Yes or no? Why doesn't it apply? Let's talk about it. And we can kind of go from there.
I just had one other question pop into my mind that I want to get out there. We just had this situation come up recently, and that is, let's say that you own a building, you complete the cost seg study. Is that cost seg study transferable to a new owner?
The answer is no. And the reason is that every time you have a new owner, you have a new starting depreciable basis. So you might have bought that building for $1 million, but when you sold it to them, they bought it for $2 million. So now we have to do that study based off a $2 million purchase price versus $1 million.
Yep.
And
Correct.
so we're going to go in and identify and put values on that stuff. Now, we have had some clients where we've kind of given them a 2-for-1, where the person selling the building hadn't done a cost seg. So we did the cost seg for the person selling the building because of the different reasons we talked about. But then the person who was buying the building also wanted the cost seg study. So we were able to do it for a pretty minimal fee because we had already been there. We had already looked at the property. We already knew how much carpet was in the building, et cetera, et cetera. So all we had to do was basically change the depreciable basis and then run the numbers from there. So
great.
There's an instance where we've been able to do that. But.
Cool. All right. Well, Erik, man, this has been very helpful. I appreciate you taking the time. Obviously, those of you that are on the podcast, it's going to be helpful to go to the YouTube channel, check it out there. And then, of course, don't hesitate to reach out to Erik Oliver at costsegathority.com. His phone number, again, is 602-568-0032. Erik, thank you so much for coming on. I appreciate your time.
Oh, yeah, absolutely. I appreciate it, David. Hopefully, like I said, we added value to your listeners today. I know I've listened to a few of your other podcasts, and you always have great content. So it's been a pleasure being part of this. And like I said, I appreciate it. So.
All right. We'll be in touch soon. Thanks, Erik.
All right, take care.
Okay. Bye-bye.
Bye-bye.